Welcome back to More Fun with Finance. I'm Dr. William Elliott, coming to you from my studio in beautiful uptown Shaker Heights. So today we're going to be talking about the material in Chapter 2 of Ross, Westerfield, and Jordan. That's going to involve looking at financial statements, the balance sheet in particular, and the income statement. We'll touch on the statement of cash flows. We'll also touch a little bit on taxes. And then a final topic will cover cash flows. One of the more important things about finance you'll find is that we in finance deal with cash flows. We don't necessarily take accounting numbers straight off of the income statement or the balance sheet. We actually make an adjustment to them so that they represent actual cash flows as opposed to accounting flows. So without any further ado, let me switch over to the slides and get out of the way here, and we'll get going. So, as I said, we're going to start with a balance sheet, go on to the income statement, talk a little bit about taxes, just a brief stop there, and then finish up with cash flows. You've probably already seen some of this material in other of your business classes. It doesn't hurt to repeat it, though. Having a really solid understanding of the financial statements and being able to do financial analysis, which is in the next chapter, are two of the most important things that you can know about finance. Later material that we'll cover in this course includes things like time value of money and valuation techniques, which are other very important elements. If you know those few things in finance, you'll be very well set. Whether you're a finance professional or whether you're working in a different discipline, these are fundamental concepts that you should have a good understanding of. All right, so let's start off with the balance sheet. Now, the balance sheet is, think of it as a snapshot, right? We're going to talk about the balance sheet. It occurs at one point in time and one point only. Whereas, in comparison to the income statement, think of it as more like a video. It looks at cash flows over a period of time. Most of the times that we're looking at these, they're either going to be quarterly or annual. So they may be looking over a 3-month period of time or over an entire 12-month year. So now this snapshot is going to be broken down into two things. We think of it as a left-hand side and a right-hand side to these statements. The left-hand side is going to have assets listed on it. The right-hand side is going to have liabilities and equity listed on it. The reason it's called a balance sheet is that the left-hand side has to balance with the right-hand side. In other words, think of the assets as something that we buy, and the liabilities and equity are the sources of the capital that we use to buy those assets. So in other words, if we're buying a $1,000 piece of equipment, there has to be an entry on the right-hand side for $1,000 that came from either a debt issue of some sort, usually a bond in the case of a corporation, or an issue of equity, something like common shares or possibly preferred stock. All right. We can further break down assets into whether they are current or fixed. Current simply means that these are assets that have a very short life and will be used up usually within the year. Things like cash, accounts receivable, inventory are all examples of current assets. Fixed assets are those that have a much longer life period. So those would be things such as a truck, a piece of equipment, a piece of property, a factory, something that has a life greater than a year. That's a very rough breakdown, but typically that's the case. Now, obviously, inventory might have a longer life than a year, but is still considered a current asset. These long-lived assets, these fixed assets, can either be tangible, that is, we can lay our hands on them, that's the truck, that's the piece of equipment, or they may be intangible, meaning there's something like a patent or a trademark. that we have, that we own. In other words, an intellectual property right. Current assets, as I said, are less than 1 year typically. So that's on the left-hand side of the balance sheet. On the right-hand side of the balance sheet, we have, remember I mentioned two things. One is liabilities and the other is equity. So we're going to start off with the liabilities. Now we break the liabilities up into two categories as well. Just like we do with the assets, we have current liabilities, which have a life typically less than 1 year. An example of which, in one of the primary current liabilities, is accounts payable. The long-term liabilities are those liabilities that have a life longer than a year. Now, some of these long-term liabilities convert into short-term liabilities or current liabilities when there's less than a year left on them. So let's say that we have a 20-year bond that's coming due in less than a year. All of a sudden, that obligation, that liability, becomes a current liability in the last year of its life. Now we go on to the other half of the right-hand side of the of the balance sheet, and that is shareholders' equity. Typically, we think of common shares, but there are a variety of other types of equity. For the moment, though, let's just stick with the common shares. So, as I said, the liabilities plus the equities have to equal the assets. So down here, you see this equation. Liabilities plus equity equals assets. It's a very important thing to keep in mind, because when the balance sheet doesn't balance, that helps us to realize or recognize that we have a mistake somewhere. This graphical representation is a pretty nice way of looking at it. So over here on the left-hand side, we have the assets. We have our current assets and we have our fixed assets, both tangible and intangible. And then over here on the right-hand side, we have our liabilities and equities, both current liabilities and long-term liabilities or long-term debt, plus the shareholders' equities. Obviously, these three items have to equal these two items over here. Now, one other thing that this graphical representation helps us to understand is that there's a term named net working capital, NWC. Now, net working capital is an important concept that we're going to be talking about a little bit later on. But net working capital, in its simplest form, is simply current assets minus current liabilities. And that is equal to the net working capital, NWC. So when you see it over here in the graphical representation, let me just clear off these markings. So we have this much in current assets minus this much in current liabilities, and that difference is net working capital. Now, the reason net working capital is an important concept is that in the typical firm, net working capital is a positive value. In other words, current assets is greater than the current liabilities. Okay, so what that means in reality is that this portion of the current assets, the portion that is paid for, if you will, or supported by current liabilities, those are well matched with one another. In other words, current liabilities have a life less than a year, current assets have a life less than a year, so we're supporting an asset, a short-lived asset, with a short-lived debt. The rest of the current assets, that area down here that exceeds the amount of the current liabilities, that gets funded or paid for with what? Well, long-term debt and or equity. So we have these short-lived things that are supported with or paid for with long-term liabilities or an equity stake, which is a very long-term liability because equity stakes in corporations typically have an unlimited life. Well, that's a problem, right? Let me give you an example that you might be able to better relate to. Let's suppose that we buy a car, okay? Typical life of a car, even if you take good care of it, maybe you get 10 years out of it, okay? Let's assume that the life ends in 10 years. And you're going to pay for it with a loan. You're going to borrow money, in other words, to pay for the car. Suppose you take out a 30-year loan on that car. So the first 10 years you're paying on the loan and you own the car. After that car no longer functions at the end of 10 years, you still have 20 more years of debt payments to pay off that car that no longer functions. Doesn't make sense. And we'll get into more details about that, but think of that as an example of why this could be problematic. Like I said, this is typical of most firms. However, it's not necessarily a good situation. All right, so here's a slide just discussing a little bit more about what I just mentioned about net working capital. NWC is usually the abbreviation that you see with that. And then we're going to go on and we're going to talk a little bit more about liquidity and debt versus equity, market versus book value, things of that nature. So the first topic here, liquidity. Liquidity is a very important concept. It's a little difficult to really wrap your head around what exactly it is, but it's one of those things that you know it when you see it. The liquidity on a piece of real estate, say a residence, a single family residence, is very low. The liquidity on a dollar bill is very high. It's very liquid, meaning that I can give someone a dollar bill and get $1 worth of value in exchange in some other form, just like that. If it's a house I'm trying to sell, it's going to take me a long time to sell that house, possibly. Even if everything is perfect, it's just that the market for a house is a little fewer individuals interested in a particular house in a particular region of the country. Plus, it's a more complex asset, and to really ascertain its value is going to take a little bit more time. A dollar bill, I know exactly what that's worth today. Now, it might change value, years down the line as inflation erodes its buying power. But right now, I know exactly what that dollar is worth. It's worth $1. So this idea of liquidity is just that. It's how quickly can you convert one thing into something else. I can convert that dollar into something else just like that. It takes me much longer time to convert a asset like a house or a piece of equipment. Even a car can take a little bit longer. Now, if I wanted to speed up that time that was required to convert it into something else, what could I do? Well, I could give you a discount, right? Put it on sale, if you will. So let's say that house is worth $200,000, and we somehow could know that for sure, that it truly has that value, just like the dollar that has 1 printed on it. It's $200,000 worth of value. Well, if I wanted to move that house in less than 30 days, maybe I put an asking price of only $150,000 on it. And then I might be able to sell it in a little bit less than the typical time to sell a single family residence. That still brings up yet another problem, though, because if I put too low a price, all of a sudden people start asking the question, well, what's wrong with it? What am I not seeing? Why are you giving me such a good deal on it? And I say, well, because I want to get rid of it really quickly. That's not a credible answer, right? Somehow I have to warranty an answer. Maybe I could say, well, I'll give you back all of your money and we'll reverse the transaction if within the next year you find that it's not really worth $200,000. I might be able to convince somebody to buy it more quickly, but I'm still taking a major reduction in price to be able to make it more liquid. Right? So liquidity is high liquidity things. I'm able to maintain the full value of that thing, that asset, and convert it into something else in a very short period of time. Low liquidity, I have two choices. One, I can wait a long time to convert it into something else, or two, I can take a price reduction in order to convert it into something else more quickly. All right, so that's liquidity. This idea of debt versus equity, and let me get out of the way here because you can't quite see that, but this is an area of study where there's a lot of literature about financial leverage, or what's also known as capital structure. Those two terms can be used more or less interchangeably. Capital structure is the amount of debt versus the amount of equity that we use to fund our asset base for the company that we're operating. All right, and we'll get into this in much greater detail later on in this class, and you'll see it yet again in your more advanced finance classes. It's a very important topic. It's possible that there is some sort of optimal capital structure or financial leverage. More than likely, though, there's usually a band of debt to equity ratio that is appropriate or will maximize the firm value. If we go outside of that band, we start to lose value on either side. You know, if we have too little debt, we don't take advantage of the tax advantage related to debt. If we have too much debt, we risk bankruptcy. And so here, let's start looking at a balance sheet. We're going to be using this particular balance sheet as we calculate cash flows and things of that nature. So let me just spend a couple of minutes describing the balance sheet. Starting over here on the asset side, on the left-hand side, we have 2 years worth of data. So you could think of this as maybe we have this dated as 12/31 of 2023 and 12/31 of 2024. Remember what I said earlier, this is like a snapshot. So on the last day of the year, last second of that day, we snap a picture of the assets and the liabilities and equities, and that's what we have here. We do the same thing at the end of 2024, and that's the second column. So under the current assets, we have cash, we have accounts receivable, and we have inventory, and then we sum those up. So in 2023, current assets amounted to $1.112 billion. Note that this is in millions of dollars. In 2024, current assets increased by a substantial amount, and we had $1.464 billion. Then down below the current assets, we have fixed assets. In this case, all of our fixed assets are tangible, meaning that they have a physical presence. And these are, this particular tangible asset is the net property, plant property and equipment, usually referred to as PPE. Net, meaning that it is net of depreciation. So remember, these long-lived assets, these fixed assets, have depreciation built into them. They have a life longer than 1 year, but their life is still limited. So back to that car example, let's say the car has a life of 10 years. we're going to depreciate the value of that car over that 10-year span by saying, okay, well, 1/10 of the value is eaten up in each year. So we would deduct that from the asset value on the balance sheet. Now, so that's what the net part of this means right here. All right. So in 2023, we had 1.644 billion in fixed assets, and that went up to 1.709. And then finally down here, we have the total assets for both 2023 and 2024, and that amounts to 2.756 billion and 3.173 billion respectively. Also note, before we move on, let me just totally get out of the way here. Note that over here on the right-hand side, we have the total liabilities and equities, and those exactly equal their respective years in the asset side on the left-hand side. So over here on the right-hand side, we have liabilities and owner's equity, starting with current liabilities. That's our accounts payable. We also have this thing called notes payable. Again, those are notes that have a term of less than 1 year. And so we have in 2023, $232 million of accounts payable. Now remember, accounts payable is what we owe suppliers, right? So we have purchased some inputs to our production process and we put them in inventory, and the supplier of those inputs has said, hey, you can pay us later, right? So at the moment we snap that picture at the end of 2023, there were $232 million that we owed to a supplier. So that is a debt. That's something we owe them. But that also supports, this inventory over here. Notes payable, it could be anything. But again, the key here is the reason it's under current assets, or current liabilities, is that it is a short-term liability. And then finally, we have long-term debt under liabilities here. And that amounts to 408 million and 454 million, respectively, in years 23 and 24. We should add in here the total of these, which would be, what is this, 836 and 314, 843. So that would be the total liabilities. Then as we move further down, we have our owner's equity, and this has two accounts in it. There typically are a couple more accounts, but this is a very consolidated statement just to keep things simple. And so we have common stock and paid-in surplus, and then we have what's known as retained earnings. So this retained earnings is an interesting concept. What it really has is it's the net income from prior years. So the net income is the bottom line of the income statement before we pay dividends. So it's the net income minus any dividends that were paid out to the equity stakeholders. And what's left is sort of due. You can think of it as that's what equity gets, because remember, equity is the residual claimant, meaning that whatever is left over after we pay everybody else, equity gets. That's the residual. Now, net income, everybody else has been paid further up on the income statement, right? We paid our suppliers in cost of goods sold. We paid our employees. We have paid our interest on debt. We have paid the government even in the form of taxes. So what's left is really what equity gets. Now, they don't actually get it per se. It actually gets fed back into the company and is used to support purchase of additional assets. So in the past, the residual income left over after we paid everybody, including dividends to equity stakeholders, in 2023, what was left in total was $1.32 billion. And then by 2024, that had grown to $1.69 billion. So that difference between the 1.32 and the 1.69 is the additional residual income that occurred during 2024 that is owed to the equity stakeholders. But instead of paying them back all of that, this simply gets put back into the firm to support the purchase of additional assets. All right, so that's our balance sheet. Now, a brief kind of sidebar, if you will. Market value versus book value. This is a concept that comes up fairly frequently in finance. The accountants do virtually everything in book value. There is a concept called marking to market, which is very useful and quite helpful to most companies. But when we look at a balance sheet, these costs on the asset side, these dollar values, are the dollar values paid for that thing when it was purchased. So think, for instance, about, let's say, let me clear this off so it's a little cleaner. Let's look over here at the plant, property, and equipment. All right. If we were to have purchased this plant, property, and equipment 15 years ago, do you think it still truly has a value of $1.6 billion? Probably not. Even here, we're talking about net value, right? But who knows? It could be considerably higher, or it might even be considerably lower if we were to sell that property and equipment today. And that's really this concept of market value, right? The book value is what we see here, the $1.644 billion. The market value is whatever it's worth today. That doesn't show up on the balance sheet. GAAP says we use the price that we paid for the thing. There's not, as they say down here, there's not necessarily a connection between the total assets shown on the balance sheet and the value of the firm in the marketplace. So even when we talk about equity, we have a book value of equity, which is right here, this $1.92 billion or $2.33 billion in 2024. That's the value of the equity on the books. But because these assets are not marked to market, in other words, their values are the historical price paid, nor are the liabilities updated, because remember, liabilities can change in value as interest rates change. Say we have a long-term debt at 3% and interest rates are at 5%. So that 3% debt is valuable, right? Think about it in personal context. If you have a mortgage today at 2.5% and the going rate is 4.5%, you're going to try to hang on to that 2.5% mortgage. You might even prevent you from moving. All right. So this idea of market value versus book value is a very important one. In finance, we're really most interested in market values. Book values are what we get from the accountants for the most part, but market value is what really drives the day for a finance person. In this example, they look at the balance sheet of Klingon Corporation and compare market value to book value and say, well, gee, we've got net working capital of $400 million on the books, but it's really worth $600 million. Then we have fixed assets on the books at $700 million, but it's really worth $1 billion. So there's a $500 million discrepancy between what we have valued on the books versus what it's worth in the marketplace today. They also note too that this is reflected on the other side, on the right-hand side of the balance sheet over here as well. Otherwise, our balance sheet would not balance. All right, so let's get back to the income statement. I'm going to jump back in here. And so the income statement is very simply put, revenues minus expenses is equal to income. And the further down we work down that statement, the top line is revenues, right? That's the gross input into the company. And then as we work our way down, various stakeholders take a piece of that away. So we've got cost of goods sold, which comes out. That is what we paid to our suppliers. We've got salaries and wages that come out. We have interest that comes out, goes to our bondholders. We have taxes that come out and go to the government. And then we have what's left over goes to equity. And that is, as they mention here, that's net income or the bottom line. So here's an example of a income statement for this same corporation. And note that this is really, it says 2024, but remember it's like a video. So it is spanning from 1/1/2024 to 12/31/2024. All right, so here's our revenue or net sales. Net because if there are any returns or discounts or anything, those are factored out before this figure is calculated. So we have net sales of $1.509 billion. We have cost of goods sold of $750 million. And then we have depreciation in here of $65 million. And so that gives us a earnings before interest and taxes. And that's usually written as EBIT, EBIT, of $694 million. Now, this depreciation piece of it is an interesting element in the income statement. It's a thing we're going to be talking about here in just a short while when we talk about cash flows. So when we sell something, even if we use credit to sell it to somebody, we have an accounts receivable, but eventually that accounts receivable converts into cash, usually within a fairly short period of time. We might give them 30 days to pay. So you can think of revenue or net sales as cash, real cash during this 1 year span. Cost of goods sold, yeah, we're going to have to pay the supplier. Now, we might have used credit for 10 days or 30 days, depending upon the agreement with the supplier. But sometime during the year, we're going to be paying for those items. Depreciation, though, is very different. Depreciation is an accountant's way of trying to recognize that a long-lived asset is going to have a life well beyond that first year. So again, back to the example of a car. Let's say it has actually in the real world, most cars and trucks get depreciated over a 3 or 5 year period. So 10 years is a bit long. Let's say that car has a useful life to the corporation of 3 years. So what do? Well, if we paid $30,000 for that car, we could use a straight line depreciation. So we would recognize an expense of $10,000 every year for those 3 years, adding up to the entire cost of the car, the $30,000. So at the beginning, when we purchase the car, it's on the books at $30,000. When we go 1 year down the road, now we subtract $10,000 from that. So the net asset value of that car is now $20,000. That's $30,000 minus depreciation of $10,000. And then the next year we deduct another $10,000. So the net asset value is only $10,000. And then that final year, we deduct the last 10,000, so the net value of that car goes to zero at that point. And this is perfectly fine and a good way to recognize that some of these long-lived assets, we use them over a long period of time, even though we pay for them up front. And that's the key thing for a finance person. When did we pay for that car? That's the cash flow. We paid $30,000 the first day we bought the car. The rest of those 3 years that we're using that car, we don't pay for it. We paid for it on that first day. A cash flow recognizes it right then and there. So you're going to see when we calculate cash flows, that piece of it, that depreciation, amortization is another thing that comes into play just like this. It's kind of a fictional expense because the actual expense occurred maybe at the beginning of that asset's life. So think of this depreciation, we're going to call this a non-cash expense. All right? So that's not an actual cash flow. That $65 million is not an actual cash flow. Didn't occur this period. We might have bought this asset, whatever it is, 5 years ago. That was when the cash flow occurred, when we bought it. Okay, so keep that in mind. As we go down the balance sheet after EBIT, we have interest expense. So this is interest on our liabilities. We deduct that, and then we get down to what the authors are calling taxable income, also gets denoted as EBT, earnings before taxes. And with current tax law, 21% is the going rate, and so our taxes are $131 million. And finally, we come down to this bottom line, right? And that is $493 million that goes to effectively the shareholders, or is sort of theirs, if you will. Of that $493 million, we actually, this particular company pays $123 million of that directly back to the taxpayers, directly back to the shareholders in the form of a dividend. That means that there's $370 million that the company retains. We're going to put a little earmark on it and say, this really belongs to you equity holders. In fact, that is where we get, if we back up to our income statement, or sorry, our balance sheet here, that is where we get this difference right here. Oops, get out of the way. All right, that's where that difference is. That $390 million is that right? No, that's not right. $370 million, sorry, my bad. Yeah, $370 million is that difference in the retained earnings at the beginning of 2024 versus the end of 2024. So that's recognizing that that value actually sort of belongs to the shareholders, at least at this point. Now, if we were to go into bankruptcy, the shareholders might not get that value, but they certainly did get those dividend payments, that $123 million that got paid out as a dividend. All right? So, as far as this next slide here, we talked about the non-cash item. You can certainly read over that on your own if you like. By the way, these slides are all on the Canvas page. So if you'd like to go back through these on your own, at your own pace, feel free to do that. I don't think there's anything else that we really need to discuss on that slide. So taxes, like I said, very short little piece on taxes here. Effectively the Tax Cut and Jobs Act of 2017 set a new flat rate of 21% for corporations. Of course, there are always modifiers to that. But typically that's what a normal stock corporation is going to pay in terms of taxes to the government. Now, if the organization is, or if the business is organized as something else, like a sole proprietorship or a partnership, LLC possibly, then different tax rates apply. We'll talk just briefly about the average rate versus the marginal rate. And I'll do that on this next slide. So here are the marginal rates. Can't spell. So the first $11,000 has a marginal rate of 10%. So for every dollar of income up to $11,000, we pay 10 cents of tax on that income. After $11,000, so the $11,000 and first dollar, in fact, that's what this should say. It shouldn't say 0, it should be 1. That next dollar gets a 12% tax rate applied to it. So for every dollar beyond 11,000, we pay 12 cents in tax. And that goes all the way up to 44,725 at 12%. Then a 44,726 up to 93,375, the tax rate is 22 cents. So remember, these are marginal rates. Marginal rates. If we wanted to get the average, we'd have to do some math. And for instance, they give you an example down here. Let's say we have a small proprietorship owned by an unmarried individual, has a taxable income of $80,000. So the first $11,000 gets taxed at 10%. And so that is going to show up here and times $11,000. And that should be a 0.1 there. And then the next $33,725, remember it's only after 11,000, so we the difference between 44,725 and 11,000 is 33,725, and that has a rate of 12% applied to it. And then the last amount is less than 95,000, but more than 44,726. So that amount has a 22% tax rate. And that means our total tax bill is $12,907.50. Now, as a percent of the entire 80,000, the average tax is only 16.13%. All right, so that's the difference between marginal and average tax rates. Marginal is what is the rate on the next dollar. Average is what is the average rate that we pay on each dollar after we've gone through the entire scale up to the maximum amount. All right, so now let's look at cash flows and how we would calculate these, because remember, timing and the amount of each cash flow is crucial in coming up with a correct valuation for a firm. The identity that we see right here, cash flow from assets, is equal to cash flow to creditors plus cash flow to stockholders, is where we're headed. Now, we're going to first calculate the cash flow from the assets, and then we're going to look at how that's distributed among the creditors and the stockholders. All right, so first, cash flow from assets. We have three different areas that we're going to be looking at. One is from operations themselves. So this is the business that we're in. We're selling things at a higher cost than it costs us to produce them, and that generates hopefully a positive cash flow. If not, we're in pretty deep trouble. The other two relate to maintaining that business. One is what's known as CapEx, or capital spending, is capital expenditures. Usually it gets shorthanded to CapEx. And that is investing in long-term assets, fixed assets. It might be that we're actually selling some, so that could actually generate a cash inflow, but usually it's a cash outflow as a business grows. And then finally, we have a change in NWC, that is the net working capital. And again, typically as a firm grows, the NWC, the net working capital required to run the firm, actually increases along the way. So typically the operating cash flows should be an inflow, and then we usually have an outflow here, and we usually have an outflow there. And the net of that, of those three things, is what's available to the creditors and or the stockholders. All right. So, and another term that you should be familiar with, and that is this free cash flow. And the textbook refers to this as free cash flow from assets. Many times you'll see it, and I use this terminology more frequently, and that is free cash flow to the firm. So that would be FCFF, free cash flow to the firm. All right, so let's get started on calculating that. Just a few notes. Operating cash flows, we don't want to include depreciation because it's a non-cash expense. It's non-cash. And then interest payments don't get included either, because those are viewed as a cash flow to the creditors. And we're looking at before we actually distribute that to the creditors. However, we do want to include taxes. Also note, I mentioned this just a moment ago, but negative operating cash flow is usually a sign of trouble for the firm, potential distress and potential bankruptcy. Net CapEx, net capital spending, is just as I mentioned, could be negative if the firm is selling some assets, but typically is positive. And then finally, addition to NWC is a phrase that gets used. And again, that's typically increasing as a firm is growing. All right, so here are our free cash flows from the assets, and that amounts to a total of 107. Now, that 107 is going to be available to be distributed to creditors and shareholders. All right. But before we get to the 107, let's look at where each of these three components come from. So we have operating cash flows first. Okay. So we're going to need the income statement to figure out where that 628 actually comes from. I've copied the income statement to immediately following this slide, or actually two slides down. I've got the balance sheet right after this slide. So let's jump quickly to the income statement and see where that 628, remember that was 628, is the cash flow from operations. Where did that come from? How did we get that? All right. So again, I'm going to get myself out of the way here and allow you to better see the screen. All right, so you can start any of a number of places. I'm going to start right down here at EBT. This is earnings before taxes. All right, we could start down here at net income. We could start up here at EBIT. Doesn't really matter. We always end in the same place. We just have to keep a few things in mind. So let's start with EBT. So that is 624 EBT. Now, since we've deducted depreciation from the revenue stream above that, we need to add it back in because it is a non-cash expense. So the actual cash flow is $65 higher. All right. And then we also need to add back in the interest because that's been subtracted out already. And so we're going to add back the 70 million on the interest, and that is going to give us 759. All right. Now, one last thing we have to deal with is taxes. Taxes are a real cash flow. We actually pay dollars to the government. So we want to subtract off 131, and that is where we get our 628 from. All right. So these are, we could start up here with 694, 694, add back the 65, and then subtract off the 131, and we would still end up at 628. So it really doesn't matter where you start. It's keeping in mind the fact that we need to always add back non-cash expenses like depreciation and amortization. And then we need to keep in mind that if we're below where we've subtracted off or recognized the payment of interest, we need to add that back because we actually want something before interest gets paid, because these would be free cash flows to not only stockholders but also creditors. And then we still have to skip down to the bottom of the income statement to subtract off the cash flow that is actually paid out in the form of taxes. All right, so that is where our 628 figure for cash flow from operations comes from. Now, let's go back to this and let's figure out where our CapEx comes from and how we arrive at that. And then change in NWC. So first off, CapEx. For CapEx, we can go to the balance sheet to find that. And I've got the balance sheet handy for us to see right here. So we have 1.644 billion at the beginning of the year, and at the end of the year we have 1.709 billion. Now, that's a $65 difference between these two figures, all right? So one might initially think, oh, we spent $65 million on CapEx, but you'd actually be wrong. Note that this is net of, or rather net plant, property, and equipment. Net meaning net of depreciation. So we've already subtracted out the depreciation. So the fact that this went up by 65 million, if we had done nothing, it would have gone down by the amount of depreciation, which we need to go to the income statement to see. And that depreciation is 65 million. Sorry for all the markings here. Let me just clear that off. In fact, I could probably go to a highlighter. There's our 65 million right there. All right. So now we actually have not only the increase, the overall increase, but we've actually effectively netted out the depreciation. We've added an additional 65 million. So that means that we have 130 that we have spent. So that's a cash outflow. That's a negative. We have 130 million in CapEx. So that's where this figure comes from. All right, now on to NWC, net working capital. Again, we want to go back to the balance sheet to look at net working capital. And what we can see here, to get our net working capital, we need to look at current assets minus current liabilities. So 1.112 billion minus 0.48 or 428 billion. And by my figures, that comes up to be 600 NWC. Let's see. Yeah, we'll do NWC there. And that comes up to be 684 million. That's a 4, not a 9. 684 million for the beginning of 2024. At the end of 2024, it's 1.464 billion minus 0.389 billion, which gives us 1.075 billion. Now, we need how much did that change? So the difference is 1,075 minus 684, and that gives us our 391. And again, since it's an increase in NWC, that's a cash outflow to the firm. So if we go back here, there's that 391. When we take 628 minus 130 minus 391, we end up with a positive 107. Now that 107 gets distributed between the creditors and the stockholders. For that, we will go to, let's go to this slide right here. Notice that on this slide, we are looking at cash flows to the creditors up here, and then cash flows to the stockholders down here. So let's start with the creditors. And we paid $70 in interest. Now remember, that comes out of our income statement. So there is the $70 interest payment to creditors. That is a cash outflow to the firm, cash inflow to the creditors. And then there was a change in the amount of debt as well. Net new borrowing, and we're going to see that over here when we go to the balance sheet and we look at the long-term debt. We notice that it went from 408 to 454. So that is the $46 increase. So that's a cash inflow to the firm, cash outflow from creditors. So the net flow to creditors is the 70 inflow to them minus the 46 outflow. And that leaves us with a net inflow to creditors that would actually be an outflow to the firm of $24 million. All right, you with me so far? Now let's finalize this with the stockholders, and we see here we have dividends paid to the stockholders of $123 million. Now obviously that comes straight off of our at the bottom of our income statement is usually where you find the amount of dividends paid to the creditors. I'm going to pop back in here, and so there's that. And then we have net new equity raised, and that amounts to $40 million. And so this is a cash inflow to stockholders, a cash outflow to stockholders, for a net flow to stockholders of $83 million. The signs are reversed, obviously. If we're looking at the firm, it's 123 cash out from the firm to stockholders and 40 million cash in from the stockholders to the firm, and a net of a cash outflow of 83 million to the firm. Where did the 40 million come from? How did we get that? Well, the way we see that, I mean, obviously we could tell if we did an equity issue during the year, but the way we see that in the financial statements is we need to go to the balance sheet again. Let me just pop over there. And you'll notice that the common stock and paid-in capital at the beginning of the year was only $600 million. At the end of the year, it was $640. So at some point during the year, we issued additional shares of stock. Now, when you issue additional shares of stock for a firm that has already done its initial public offering, its initial stock offering, that's an IPO, right? It's already done its IPO. To do an additional issue of stock, new shares, we do what's called a seasoned equity offering. In other words, the equity is already in the public hands and trading. We're just adding to that amount. So we went from maybe 1 million shares to 1.1 million shares or something of that nature. But the end result is that we increased the amount of stock that we sold to shareholders by $40 million. All right. So now let me go back to this slide. So here we have the 123 minus the 40 gives us the 83. And again, these, let me jump out of the way. These signs are relevant to the stockholders. They would be reversed for the firm itself. All right. And notice that this 83 plus the 24, it adds up, lo and behold, to 107. And that is exactly the same amount as the cash flow from the assets. So everything is good in the world. Our cash flows all match up. And those are important figures for us to recognize. These are really this is kind of the foundation for what we use when we value a firm. So we're looking at these actual cash flows. We need to know the timing. Here we don't actually have the exact timing of these cash flows, but this gives us a general picture of the cash flows over that year. And then we'll close out this chapter just with kind of a summary of how the cash flows are calculated here. And that is this little diagram here. So here is the identity again. The cash flow from assets is equal to the cash flow to creditors plus the cash flow to stockholders, or the opposite. Cash flow to assets is cash flow from creditors plus cash flow from stockholders or equity stakeholders. And then the cash flow from the assets is three things: operating cash flows, change in CapEx, and then change in net working capital. We have operating cash flows. Those are, we could start, and like I said earlier, there are a variety of places we could start from. Here is one possibility if we start at EBIT, and let me just show you briefly EBIT. Okay, so where is EBIT? EBIT is right here, right? We could have started from this 694 figure. And if we had done that, we would add back the depreciation because it's a non-cash expense, and we would subtract off the taxes, which are below the EBIT, but they are an actual cash expense. Net CapEx is the ending net fixed assets minus the beginning. And then we always add back depreciation too, because even if the ending fixed assets went down, if they didn't go down by as much as the depreciation, we were still spending on improving or increasing our fixed assets. And then finally, the change in NWC is simply the ending NWC minus the beginning NWC. And then the last two items, cash flow to creditors, interest paid minus net new borrowings, and then dividends paid minus net new equity raised. So, in sum, we've looked at the financial statements, in particular the balance sheet and the income statement. We've touched briefly on taxes, and we'll dig further into that later in the semester. And then we've looked at how we calculate cash flows. Cash flows are just so important that you understand this. So if you have any doubts about this, make sure you go back and review that part of the text. Come back and review the slides. Feel free to reach out to me via email if you have any other questions about this or want some additional clarification. I'm always here to help you out with that sort of thing. And otherwise, I will wrap up this chapter and see you at the beginning of chapter 3. Thanks very much. Good night.